All right, so let me begin by saying hello and welcome to another weekly edition of Stock Market Mutterings. This is for the week that begins on August 5th, where I will do my best to take a grope in the murkiness and try to find you some quality trade setups. And man, let me tell you, I got my work cut out for me this week. I got some groping to do, and I'm going to grope away, so please stay tuned. Now, what I'm also going to talk about here is some tips that I've learned over 2 decades of trading through multiple different types of market sell-offs and market corrections. I'm going to give you some of you guys some tips out there on the best way to trade it, because just like I said in the market mutterings and some of my YouTube videos, if you don't believe me, just look through the channel, go back to December, and I was saying that these types of market sell-offs that we're experiencing, these types of market volatility moments are some of the best trading opportunities that you will ever find, hands down. There's a right way to do it, and there's definitely a wrong way. So I'm going to share some of that with you guys today, talk about my thoughts and feelings about where we might end up going, and so on. Plus, give you a few stock trades. How about that? So let's go ahead and get started. I'll begin with the market itself. And if you go back to last week's market mutterings, we were talking about the potential impact of this Fed announcement because the market had already priced in a quarter-point cut. So in my opinion, anything that was a quarter-point cut or worse, no cut at all, could be potentially disastrous. And when I say disastrous, I might be exaggerating there. Would be a negative. Let's say a negative for the market. And that's what you got. And I think after that, the market really desperately wanted that half a point, but it wasn't happening. They gave you this quarter-point cut, and it kind of delayed reaction up there. This is Wednesday, I'm showing here on the chart. There was a little bit of a delayed reaction. Fed starts speaking, kind of confuses everybody with their jargon and incoherent slang that they like to speak. And down she goes. Well, it kind of snaps back there and settles in. So you had this little erratic movement. And over the last couple of years, the Fed Fed events have been sort of a non-thing in the market. I mean, there was a time when I was trading years ago, up till a couple of years ago, that it was a big day. So we're finally starting to see that again, at least. So I guess overnight people digest it. You don't know really what to expect going into Thursday. Are we going to sell off and go lower? Are we going to go higher? What are we going to end up doing? Well, we just took off straight from it. Like everybody wanted to buy back in everything that they sold. And you saw this monstrous ramp. And it's like clicking around there at all-time high. And then Trumpster gets on the old tweet machine and says, tariffs. And man, this market really didn't like that. Now, tariffs haven't been such a big deal for the market. Yes, they've had their moments, but the Fed has had more of an impact than tariffs because this whole tariff war, this trade war has been going on now for over a year. And the market's just been banging out all-time highs like it's nothing. It just keeps rolling it right off. But I think what you saw here is that the impeccable timing that you've recovered. I mean, here you recovered all the way back from this sell-off from the Fed. You come all the way back and you're within a nugget of highs and you toss out that tweet. I mean, what timing, right? And I don't think the market was ready for that. I don't think the market participants were ready for that, and it didn't set well. And you can see it just sold off. And from that point, it just continued on and on and on all the way through Friday. There's just zero interest in buying anything at this point. So where do we go from here? What should we be looking at? We'll talk about this. You got right down to the 50 moving average here. I got the SPY chart up. You got right down to the 50 moving average and closed just a tiny bit above it. And that's really in this area is probably a high probability of a bounce point. Now, I don't know if that's going to be the first move that you're going to see on a Monday or if you're going to sell off a little bit, but you did come into the levels very close to the 25th, the 24th and 25th of June, which was support. And I would think going forward, you must pay attention to that 50 moving average, and you must look at June area there of support. If it doesn't hold that, you're probably going to cycle a little bit lower, somewhere down around 288. But really what I want to touch on this is when people see these events, they begin to panic, and I can understand. But one thing that you have to understand is the market does not crash from all-time highs. When a market makes a significant correction, there's usually some signs prior to what you're seeing, like now, before the real crash, or let's say the real correction kicks in. Now, if we go back, I'll show you what I'm talking about. And every correction that I've ever been in has worked somewhat the same way. Maybe not perfectly, but they all kind of work the same way. And what it is you start out with this initial event that really starts shaking the market. Comes out from highs or whatever it is. It starts to shake the market. You start to press downwards. And then the natural knee-jerk reaction is to buy those discounted stocks, is to buy those discounted prices. And that's what traders do. And then the market will bounce. Then what happens is it rotates lower and takes out that previous pivot. I'll show you guys what I'm talking about here in just a second. And then you get another press down. Then they try to buy up that dip, and then that gets failed, and then you really, so like on the third wave of this event is when you really see the thickness. So when we talk about, let's just go back into recent. You can go back, the dot-com worked this way, the credit crisis worked this way. I've talked about this before. For the sake of time, let's just go back to December and talk about it, because people say, the correction was in December. Well, that's when the big one, but the clues came in October. So if you come back here, I got a big old mess here on the chart. But the clues here were you got the first initial wash on the market in October. Then here's what I said. It got bought back up, but it failed to make a new high. Then you rotated lower, taking out that pivot from the 11th, and then you made a new low. Then you found some footing down there. And these are probably support numbers. If I go back further in the chart, they probably mean something significant. And then you come back up to the highs, not the highs, but you rally back up to the previous resistance. Then you come back down again, right? Then it tries again. And each time it's trying to rally, the rallies last shorter and the actual price points are shorter. So they don't reclaim new highs. They just get rejected prior to resistance. And then finally, in early December, it loses that base of support that it had been fighting from since October. And then that's when you really see this capitulation point. So what I'm saying is you're not at a capitulation point here. That's not it. This market will bounce. It may not go back to all-time highs, but you'll see a bounce. You're going to see a bounce early on in the week. You're going to see an attempt to try to save this. This market's been too strong and too bullish for everybody to just, throw the baby out with the bathwater right here and capitulate and see this mass event. Now, could it happen? Hell yeah. It's stock market trading. History may not mean shit, right? It just could do whatever it wants. So that's some of my thoughts and feelings about it. I think you're going to see a bounce roughly between where you sit right now and 288. 288. And now, bounce points, maybe you go back to the moving average, 296s, 297s, but one day at a time with this. I don't think you're going to see all-time highs next week. I don't think it's going to V-shape rally here, but only time will tell. Now, just another quick tip about trading through these corrections. So remember, number one is they don't crash from all-time highs. You're just going to have to cycle down. You'll learn more data as the weeks progress as to whether or not this is going to sink its teeth in through the fall. And the other thing is pick your spots a little easier. Make sure you're really, really picky about what it is that you get into. Use stops in this market. You have risk is off the table. You can't use heavy position size. You can't sit there and have mental stops in a lot of cases. You're going to get burned. You're going to get burned because the volatility is going to stay for the next week or so. It's going to have to balance itself out. So you're going to have to get used to seeing some of these really large, thick candles. So whatever you're trading now, within its range, if it trades $1 a day, up and down at $1 or $2 or something like that, double it, triple it, because that's the kind of stocks, that's the kind of moves that you might see. So if you're trading Apple, you could see $5, $6 a move every day. Facebook, $5, $6 a move. So that's my thoughts. Now let's talk about these stocks, because I'm just going to run through them here quickly for the sake of time. I still think the value early on in the week is going to come from picking up some of these on a dip. And I think the ideal scenario to where you make the most money is if you panic down early on Monday, washing all these stops out, and you pick some of your favorite stocks, some strong stocks, like let's say Apple, Facebook, or some of the things that you really like, Lulu or something. Find some spots where you definitely would buy that and throw yourself some orders in there and see if they get filled in some sort of pre-market dump or some flash drop or something like that. But I'm going to look at WDAY. I'm looking at anything that might bury itself down into support. If they don't do that, I'm not interested in them. I'll have to let them build some intraday patterns. I'm just going to run through some quick charts. I've got WDAY. If you get down to 189.72, which is the lows from May, I like this one. I like Apple, like I just mentioned. If you can get Apple to come down into, I've already got some of these set up, 200 flats, or somewhere into 197, between 197 and 200, which is the 50 moving average. I also like COUP, C-O-U-P. This one actually held up real well. going down in its 50 moving average, or if we have strength early on, possibly just using this as a regular bounce trade because this had some relative strength against the market, and MCD had some relative strength. So you had a couple of these that were going down a lot. And then you had the last two here, MCD and COUP, where you had, yeah, these were relative strength. The rest of them were already washed out. And you could even put Facebook on there. So here's what I'm talking about. There's going to be a ton of stocks that look the same way. They got blistered up dailies. I mean, they were at all-time highs on Tuesday, and before the week is over, they're just like in a drunken stupor laying in the mud. How quickly things can change. And again, this is market trading, right? This is market trading. And I'm sure some of you are frustrated because you're just rolling right along with the all-time high thing. Like, look at me, I'm just making all this money. And then, pow, this comes up and it's like, geez, that was fast, right? It's still market trading. So what I want to do is I want to look at these. Here's another one, like Facebook, maybe down into the gap. I'll put this alert here. That would be 184.50. Yeah, let's go 184.50. So here's what I'm looking at. This is what I'm talking about so I don't confuse people. If you find those stocks where they're going into multi-month support, so if you're going back into June and May, and you're looking for these supports or pre-earnings parts of their supports, and you say if the market shows weakness early, if these things just bury, I'm going to talk about bury, the first move you start out in the day just goes straight in, right down into that support fast. A fast move. You've got to have a fast move. That the fastness and the speed shows the capitulation. You get into that support. Almost 95% of the time, that thing's going to bounce and bounce hard. It might not go green, but it will bounce. It will get defended in most cases down at that level. Now, these may not work out in that case because you might not see something like that. You might get some wacky open where it's a partial gap. So if you do gap up and none of this stuff buries into the supports, take them all off the table and just look for standard intraday bases and bottoms. You don't have to just buy dips or buy reds until you find some sort of base that's being built, some intraday support that's being built. Taper down your sizes that you initially start with to give yourself some room and use a stop. You can trade nicely through these corrections because trying to time the exact moment of a bounce can be next to impossible. So don't try to do that. Some of this stuff has a lot of room to rally. You just gotta be patient with it. So if we panic down early, I would be looking to really get aggressive. If we open up flat, you're going to have to give it 20, 30 minutes maybe to settle in, pick a side, and really look for your setups there. If we gap up, I would take that with a grain of salt. I might even be leaning to the short side because I'm not sure. I would think, hey, this gap may not stick. It could be very sketchy. You'd have to check the volume and such. But pay attention to it. So again, some tips there to trade through the correction. There could be a lot of great opportunities, but like I said, at some point it will stop. The market will bounce. It will provide you with a ton of opportunities, and you'll learn to just embrace these types of moments. If you need help with that, visit thelinkenlist.com. Thank you for watching this week's Market Mutterings. Take care. Trade them well. Talk to you next week.